Hi, everyone. Welcome to the 133rd episode of the Timing Research Show for April 10th, 2017. My name is David Kosmeter. I'm the creator of Timing Research. Today, we will be discussing the 185th weekly report. If you haven't had a chance to take a look at this yet, just go to TimingResearch.com/reports. You can download this or any past reports there. I have Matt Buckley back to host today, so I'm going to go ahead and turn it over to him.
Thanks, David. Appreciate it having me back as a host again. Have a very busy week here at Top Gun Options, which we'll get into, and I'll introduce myself more in a couple minutes here. But as you said, we got Andrew Keene from Alpha Shark out there, I think, on the left coast. Jim Kenney from, you're up there at Jackson and LaSalle, somewhere within that radius, I think, Jim. And Jason Jankovsky from the Lion Online. Andrew, let's keep that batting order today, all day, guys. Andrew, Jim, and Jason. Andrew, why don't you give us all a quick executive summary of your background and what you're currently doing at Alpha Shark?
Andrew Keene, CEO and president of AlphaShark.com. I traded as an independent market maker at the Chicago Board Options Exchange for about 10 years. I was a market maker, and Apple was my biggest name back then. As trading has evolved, it's become a lot more electronic. So I trade from upstairs, use 4 monitors. My company is AlphaShark.com. I currently run one of the largest trading rooms throughout the course of the day. So it's 8 hours of audio and visual. I'm personally in there for about an hour and a half every single day, usually trading the opening bell. I trade equity options and a little bit of stock too. I'm a very active trader, could trade up to 1,000 options in a day. And then we have some proprietary based indicators and courses as well.
Awesome. Andrew, welcome aboard. Jim, good working with you again. Tell us a little bit about your background and what you do at the op.com, Options Professor.
Okay, at Options Professor, I provide the content for the Option Professor DVDs. There are 7 DVDs available. They work for the beginner as well as intermediate and advanced traders, going over the buy and the sell side, the use and the risk of many different strategies. Some people want to learn more about how to write the options. Some people want to use them as a hedge against positions, and others want to use limited risk speculation. And so the DVDs are very informative for people to come up to speed on how these strategies work and how they don't work, and what might be right for you and what might not be right for you. And I've been explaining the options now for quite a long time, decades. So there is quite a bit of good information on there. And of course, we'll invite you to pick up those DVDs at the end of the broadcast.
Awesome. Jim and Jason, your background and what you do with theliononline.com.
Sure. I'm an independent trader. I trade only my own accounts right now. But prior to that, I've been in the business since 1986. I did my very first trade in Chicago Board of Trade, big board corn. And as a customer, I started as a customer, just like everyone listening does. And I got into the business as a registered Series 3 broker the next year, 87. And through the course of my trading career as a broker and on the inside of the business, as well as trading my own accounts, I learned anything that any one of your listeners might have as an issue for net gains. I've been through that 100 different ways from Sunday. And what I've done is chosen to focus on the psychology behind trading more than anything else. And up until just recently, I offered education and training services on trader psychology, developing an edge, how to know if your edge is viable, understanding probabilities, all the things that everyone is trying to do every day and exploit the markets. And in that process, I discovered that the typical average, I would say, trader, and a lot of people that are actually participating, I wouldn't call traders, but they're trying to become traders. I think most of them that have achieved any degree of success that's lasting would say that the psychology behind what they do is infinitely more important in many cases than the actual strategy they use. The strategy has a probability to it. What they're trying to do is get that probability to drop to the bottom line. And that's what I try to focus on, is my participation, managing what I do and the way I do it, along with the edge that I've developed. And I trade right now about 90% of the time exclusively in foreign currencies, cash forex, but I also still trade futures and occasionally options. And what I do right now with the Lion Online is just make myself available to customers that are interested in learning more about the psychology behind what they're doing on a one-on-one sort of basis. I don't actually hold myself out as an educator anymore. So if there's anyone listening that's interested in knowing more, all I got to do is go to my website and fill out the form that says support, or I'm interested in learning more, and we'll take a few minutes and talk.
Awesome, Jason. And for the folks that don't know me, my name is Matthew Buckley. You guys can refer to me as Whiz. My parents did like me. That was a call sign I earned flying the Hornet, the F-18 Hornet for the United States Navy for about 15 years. And then took my kind of amateur trading and took it pro. I helped run Peak 6 Investments, one of the largest vol arb firms in the world, at the intersection of Jackson and Sal. Was the founder and CEO of the Options News Network, kind of the CNBC for options, and then decided Chicago winters were best left for people other than me, and then headed down here to beautiful South Florida, where I started Top Gun Options about 7 years ago. Got a big launch going on this week, which we'll talk about towards the end if you're interested. But just kicking off from a high level before we get to where the market's going and talking tactics with these guys. Just what an incredible week last week. Starting, I haven't seen one. I was going to use the word volatile weeks in years, but it really wasn't that volatile. If you look at a VIX from 11 to 13, I mean, that's just, that's our resting heart rate. We saw a 14 handle this morning, but folks, we started the week with the unmasking of deep throat Susan Rice, so to speak, Chairman Nunez from the Intelligence Committee resigning. Then we get ADP blowout numbers. The Fed poo-poos all over that. Then the Gorsuch, the Reid option, then Trump's lobbing missiles into Syria, and then we get a anemic a decimal point or numbers missing in the jobs report on Friday. So if last week your head wasn't all over the place, it was absolutely nuts. So wanted to debrief a little of last week to kind of set the tone for this week, because it feels like there was a lot of face slaps last week of everybody, and now we're just kind of here rubbing our face. So I'm gonna, with that little bit of a debrief from last week, over to you, Andrew. Let's kind of squish questions 1 and 2 together. Where do you think we're going to close on Friday, higher or lower from our open today? And give us your delta. What's your confidence on that?
Yeah, I've been playing a little bit to the bear side. I had a really good week last week. Today, I came in pretty flat. I'm short a couple names. So I think we're headed lower, but I'm not very convinced very thoroughly. We do have no work on Friday. The market is closed. It's Good Friday. Market will be closing on Thursday. So we only have really 3 days of trading. I think it's going to be a quiet week just because we have the Jewish holiday of Passover tonight. And then we also have Easter on Friday, or Good Friday on Friday. So Easter this weekend. So I say 55% chance down.
55 delta down. Okay, man. Jim, what are you looking at this week as far as where we're going to close on Friday, and what's your delta?
Well, with regards to all the volatility back and forth, it's looking like a lot of much ado about nothing, because we're still stuck in the same range that we've been stuck in for a while. That range seems to be tightening up a little bit. We were in a 2400, 2320 range. Now it looks like it might be 2370, 2320, or this is on the S&P, or even 2370, 2340, which is about last week's low. So this thing is tightening and tightening and tightening, and it's right in the middle here. So I see it as any man's guess. So here's what I'm, and again, this is just my opinion. The end of month options on the E-mini, the puts are substantially higher than the calls, and the VIX is up in the 14 neighborhood, as Whiz was saying, which is in the higher end of the reading since the election. So if you have the puts rather a higher price than the calls, and the VIX at 14, which is the higher end, I'm thinking it might rally this week. And so I'd put that, because we're smack in the middle, I'd say it's 50-50.
I like that. I think you guys are setting up the trade that I put on this morning perfectly. So I'll send you guys all $100. It's awesome. And Jason, what are you thinking for the week?
Okay, I'm taking a little bit longer time frame look at this, and I think everything that you discussed about last week and the issues that the market's dealing with this week, and you look at price action in the past couple of months since the start of the year, the weekly, or I should say the yearly, actually, the yearly opening range, the market's testing that area. And I think in the past 3 to 4 weeks, it just has not been able to close consistently above the yearly opening range with any positive momentum. And I really think the market got ahead of itself, and we're coming from all-time highs, failing at all-time highs, and not able to continually stay above the yearly opening range. And now we're into the second quarter with so many questions unanswered about the new president. I really think that the loser is on the buy side. I think the loser got trapped on the long side, and I think you want to be a seller on lifts. And I think for this week, real strong probability we're going to end below the weekly open. So I'm about 80% sure of a move to the downside. There might be a little wiggle to the upside to say maybe right, I don't know if you want to pick numbers, but maybe right around the 2360 area, maybe a little higher. And I'd sell it with both hands right there and wait for the close, because I really think the market just got way ahead of itself at the start of the year, and it's just not attracting enough buyers. Look at some of the down volume on some of these big moves lower. It's been really high, and it's been coming right from the 2375 areas, but the single biggest down bars that the market's had on a 4-hour chart. They're huge, and they came off the 2370 area on good volume, and it's just not following through to the upside. I think the buyer is the weak hand here.
Very interesting. And you said, well, obviously being the host and getting you at last, I'm going to say you guys are all wrong. But no, I mean, actually, it's a smattering of everybody nailed everything. So if you guys can see my chart, interesting you said that, Jason, the 2360, and as you were talking the entire time, this is kind of the Maginot line there, this 2360, especially if you look on the 4-hour chart. So take a look at that. So there's I sent out a SPX bear call spread right here this morning and a bull put spread. So I'm in an SPX iron condor for the week. So I'm an unched to slightly higher, and here's why. Take a look at the past couple weeks. So here's so I'm sliming into question 3, and I'll let you guys give your question 3 answers. Here's the end of the world, the end of Trump. It's over. The guy's an idiot with the healthcare debacle. That wasn't going to happen, folks. So we tested, didn't come super close, but we tested that 50-day. Oh my God, he's not going to be able to get anything done for the rest of his presidency. Good bounce off the 50-day. Same thing last week. Oh my God, bounce off the 50-day. Folks, I think the Neil Gorsuch thing, the cruise missiles into Syria kind of recaged his gyros, especially with some Democrats coming out of the woodwork to support those strikes. So after a week of all of that stuff, this 50-day moving average, folks, I'm sure all of us are of the ripe age where we've watched The Price is Right, maybe homesick from school, where that yodel guy or the mountain climber, he yodels up and then that's the 50-day moving average, man, is that Price is Right guy going up here. And he's either going to go up and make it or we're going to implode. So the implode reasons to the downside right here in this white space, to me, you put North Korea. I got 3. I'm very good friends with the CAG, the commander of the air group on board the USS Carl Vinson, and they just got completely screwed. They've been at sea for like 5-6 months. They were going to get a port call in Australia and come home. They got the good morning, Carl Vinson. This is the captain. We're not going to Australia. That is all. And you probably heard 10,000 voices cry out because they're turning around and going to North Korea. So to the downside here, you can throw in North Korea, Iran, Syria, Russia, and the Trump agenda in danger. To the upside here on the right side of the chart, I put earnings and I put Trump agenda back on. So if we're talking about just this week, I think we're going to yodel. We're going to price this right along this 50. So I think we're going to finish slightly to the upside. And I got some things on my radar for this week. But as you can see, like I said, I sent out 2 SPX trades. I'm both filled on with an iron condor. So my certainty is, we're going to try and thread the needle here. Let me just group these together as a mumbling, and so I can see what the risk is. And that's what I've done for the past 3 weeks after the healthcare. Oh my God, this guy's an idiot. You might believe that, but at least healthcare was never going to be bipartisan. Just like not one Republican voted for it, not one Democrat voted for it. Now let's all be adults and see what we can do. I think the tax relief, the gutting Franken-Dodd, and the infrastructure spending is going to happen. It will be a little messier, but the Trump trade isn't off. I agree with Jason that we got a little over our ski tips with the financials and stuff, but I think the bias is to the upside. Even though you trade the market you want. I'm sorry, you trade the market you have, not the market you want. I think Andrew or Jim kind of said, hey, I think we're all a little squeamish here. But you got to put your Gordon Gekko on and say, hey, this is the market that we have. And, the one we want ain't necessarily going to happen. So, Andrew, how about over to you, man? Any comments on that? Or what event specifically is driving your slightly down to the 55 Delta side for the week?
Yeah, I mean, we do have some earnings this week. JP Morgan, I think, reports as much as I think Wells Fargo. So we have some bank earnings. And, one thing that I find very interesting out of today, I watched the VIX, that's known as the volatility index, and it's up 65 cents up to 1352, which doesn't seem like a big day big, but the market is up and the VIX is up, so that's really interesting to me today. I still think a lot of the Momo names have more room to run on the upside. Amazon, Tesla, they're just so strong to the upside. But I think the bank earnings will be weak this week, and I think that will help us roll the market over. And I just think that we're not. Price action, price momentum has been to the downside. Like I said, my conviction's not that strong, but I think the combination of those makes the market go down from here.
Mm-hmm. I think it's interesting you put that that way, because the conviction is kind of wallowing around here. Like I said, all the events of last week, I think people are still trying to catch their breath. And oh, by the way, another terrorist attack in Sweden. So a lot of geopolitical, and you hit it right, Andrew, with the J.P. Morgan. We'll see how the Washington Blue Bloods, the Wall Street Blue Bloods do with the Goldman Sachs, J.P. Morgans, and the Wells Fargos, because they are the kind of the canaries in the coal mines, especially the transports and the financials. Jim, what specifically on your radar is driving your mindset of a kind of a 50-50?
Yeah, well, only because obviously we're in the middle of a trading range, and if these earnings turn one way or the other, they're going to obviously have a big effect. I was just saying from the end of month options on the out of the monies and the VIX, it was something that was kind of leaning towards a little bit of an oversold type thing. But at any rate, getting back to a couple things that I'm kind of looking at, in my opinion, one is the transports. They're going to be, they at one point did drop as much as about 9% from their highs. They bounced back up nicely now. We got Delta coming out Wednesday, so it'll be interesting to see how their earnings are. And as Andrew was saying, these banks are going to have to acknowledge some of these bad loans on their autos, and also the differential with the yields dropping is getting the bloom off the rose a little bit on the bank. So they're going to be big earnings as well. Bigger question might be is how the overall situation will be resolved. And not very often on TV do I see anybody who I coincide their opinion. But I did watch last week, and I saw a gentleman who's the head of a firm, a pretty good sized firm on TV. And he was explaining his opinion on how this thing will get resolved. And basically he was saying that we've been going up or down 2%, meaning people are fading a rally of 2% higher, which is towards 2,400, and they've been buying dips towards 2,300 on the drop. So we've been in a 2% up or down deal. His belief, and I coincide with this, is that when that 2% up or down does break, there could be a vacuum, meaning a illiquidity situation where the volume comes in extremely heavy, and obviously there's nobody on the other side to speak of. So that's what a order imbalance looks like. And that could take you up another 5% real quick, or down another 5%. So his essential opinion was, and I coincide with this, we could go between 2,400 and 2,300 ballpark up or down. But if we do break either one of those numbers, an additional 5% up or additional 5% down could happen very quickly. And then his opinion was, and I would probably coincide, that I'd be looking to possibly take the other side of that situation. So again, your window, 2,400, 2,300 ballpark up or down a little bit. And then if you break that, you could be up towards 2,500 ballpark area plus or minus, or 2,200 plus or minus pretty quickly. And these earnings that are coming out now, plus the Fed meeting in June, this is a little longer term view, but a month or two goes by pretty fast. And I'd be looking at some potential of that occurring in the next month or two.
Talk about a confusing week for the Fed. I mean, that ADP report Monday or Wednesday, just rip your face off. Holy Batman job creation. And then the Fed minutes come out Wednesday, just like a fire extinguisher, very, very hawkish. And then we got that ridiculously anemic. You didn't hear Trump tweeting or on the lawn doing cartwheels over that report. A little silent. So it's going to be interesting for the Fed. I want to pick up on something Andrew said, spoken like a true options trader. Market up, VIX up, something's up. So, if there is a little bit of a upness to the week, it's kind of a hold your nose rally. When the market is up, the VIX is up, something's up. It's traders going, yeah, okay, we'll do a little bit of buying here, but pay no attention to me as I kind of walk over to the VIX box and grab some of this stuff because it's pretty cheap. Let me share this real quick. If you take a look at the VIX, and for folks that have been options traders for a while, this is just ridiculousness. Look at the resting heart rate of the VIX. It's an 11, folks. And then look at what this literally looks like a heart rate monitor. Look at that, up, down, up. We get a, there's the, the healthcare debacle, whatever. But look at this smash through 13 is telling us something right here, that if we're still going to kind of go up a little bit, folks wanted a little bit of protection here. So we're outside of kind of this resting heart rate range that we've seen for the past 3 months. And then the last canary in my coal mine I was looking for the week, sorry, Jason, for jumping in front of you, is the at the money straddle. And Andrew could probably tell you, if you take a look at the at the money straddle on SPX, the S&P 500, you could get a model down here in Miami to turn sideways and walk through it. It's a very, very tight at the money straddle. If we take a look at the 2360, wait a minute, that's regular April expiration. Let me go to the 13th, 2360. Take a look at the at the money straddle. And what this does, folks, if you're not an options trader, nobody knows what the right side of the chart looks like except jerks at cocktail parties, right? So $27 to the up, and that's a very, very tight, even though it is a shortened week. The options market is pricing in a move between the 23.35 and that 23.85-ish number. So if you look at the at the money straddle, it is a little tight for this week. So at least the options market ain't pricing in a move that big. So again, these are some of the things I was looking at, and I will yield the rest of my time to the gentleman from the line online. So Jason, what are you looking at this week?
Okay, I have to tell you that some tremendously strong arguments made by your guests and by people on the outside that run companies and all the rest, and that is in and of itself, I think, part of what the issue is people are really choosing sides, and they're really choosing sides because they have a real strong conviction somewhere. And what's happening, I think, is that the professional is selling into rallies and waiting. I think the average participant, person on a smaller time frame, is continuing to buy the dips. And I really think that if you look just at, in fact, if you could, I'll tell you what, Whiz, if you could put up that chart you would refer to on your first set of comments there real quick. I wanted to just offer an insight to you, if I could, if it's the right one, if I can get you to ask it, put it up again. I think it was the weekly S&P. And you had, you said over in the white area over here.
Oh, yeah.
So it was you know which chart I meant?
Yeah, here.
All right. If you look at this real quick, and I just want to draw your attention to the overbought, oversold indicator down here, MACD. Look at where MACD peaked back in December, and then where it peaked again at the start of the year. And that is a classic case of divergence in the market from an indicator to price. Market makes a new high, the indicator does not, and the market can't equal or exceed that high, usually within about 30% of the time it took to do that. That is a real strong indicator, I think, that there's professional action in the market on the highs, and the reason the market can't, it's overbought and it's staying overbought, and the indicator is starting to slide off while the market continues to make a new high. That's usually an indication of less sophisticated money wanting to play. And they're usually late to the party. So I would say that the psychology is setting up for whatever the breakout is. If it's to the upside, I bet it's a short, fast spike and it's sold hard. And then the market crashes, or at least comes right back down into that range and stays there again for maybe another few weeks. I really think that the setup is long-term smart money is fading strength through, I would say, the next 6 to 12 months. I think is what they're doing. And I think what that basically says is that it doesn't really matter what the news is because it's already in the market. People are of the opinion that our new president just isn't going to be able to put it together like he thought he could. And that's going to really cause people to be a little nervous. And when they're nervous, they liquidate. And what do professionals do? They're ahead of the curve 6 months anyway, 4 to 6 months. So I think that's what happened. I think that smart money is selling into these rallies, and it's going to, sooner or later, we're going to get a really sharp break lower on high volume, and it won't come back. So it really is. Yeah. I think, could that be this week? I think that's what we're all trying to figure out, right? Is it this week or not? I think that you want to sell strength because I think the smart money is getting positioned for a break lower that's going to take maybe a little bit more time.
Well, it's in my opinion, it is turning into a binary market. And this sounds like rocket surgery, right? We're either going to go up or we're going down. The market doesn't like this. Just around the 50-day, right?
But after all is said and done, the market really could go either way. Right?
Exactly. Print that one. But here's the You're right. I called this the hope and change rally. This rally is all built on the hope that Trump can get shit done, and then we're waiting for the change. And the change is either going to be he ain't going to happen, or the Carl Vinson battle group takes out, cream of some young guy, or he does prove he can get stuff done, and we get back out on the rally horse. But to sell him the strength, here's a perfect example. The State of the Union right here, this pop the next day was for stupid people to buy into. It was a short squeeze because everybody knew he was only going to say the same thing he's been saying, but he sounded maybe a little bit more presidential. So I sold the hell into that. But you're right, Jason. I still think we're seeing some BTFDs out here where it's worked for the past 3 to 5 years that you buy the frigging dip.
Right.
Unless it was coming in that this was a unique, obviously, the election, but I still think it's BTFD until we see a complete breakdown in, okay, Paul, we're not getting any tax relief, or it's going to be a complete train wreck. So,
right. And that will discourage a lot of buyers.
Oh, yeah.
Yeah.
Jason, what's your take on everything we were just covering there?
Well, I think, see, this is the funny thing about this business is so interesting for that exact reason. I mean, you could build a case that's got great potential on one side, build a case for great potential on the other side. And after you look at everything, you really have to be like situational awareness. So you're a fighter pilot. I mean, you do all the planning, you do all the strategy, you get out there and some idiot didn't take the remove before flight thing off and you can't shoot your missile. That's something that happens in real time.
Yeah.
That's not something that you can plan for. So you have to make a change with that could cost your life. In trading, our money is at stake, and something could happen a week from now. The wild card, what if it's a full blown take out everything in North Korea that isn't part of the Stone Age? That is going to just cause a change that all of our talking about on Monday wouldn't make any difference at that point.
It doesn't matter. Yeah. Well, last week was a perfect example how what happened that day was forgotten about 24 hours later. Andrew, what's your take on everything we were just chewing on?
Well, I just think it's interesting to see the market holding up with all the uncertainty and turmoil we've seen, in the terrorist bombing in Sweden as well. We just continue to find buyers at some point. The market's gone, I think, the longest in history without a 10% correction. 10% corrections happen about once a year on average, and this is the longest that we've gone. So I'm usually a bear at heart. My best 2 years trading were 2007 and 2008, when the market was down. I trade better when there's higher volatility. When we just grind higher, it's always harder for me. Interesting to see the market going up. I think there's going to be a massive correction sometime while Trump is president. If he tweets something dumb or something happens that he can't rationalize, but the market is price action, price momentum is still decently strong, and he continues to get bought on a dip.
I think he's tweeted a lot of dumb stuff so far, but that's a story for a beer. Andrew, what are you doing as an option? Talking to our folks out there, because this is a standard question I hear at TGO. I never went flying, and Jason, it's a great analogy. It's one of our taglines here at TGO: is trading is a form of combat. Somebody's going to win, and somebody's going to get their ass kicked. And what side do you want to be on? In combat, flying fighters, that we used the most priceless capital there was, a pink body, and obviously in trading you're using physical capital. So I never went flying without an ejection seat, and my portfolios have ejection seats. I'm looking at SPX bear put spreads out to the end of April and into May. Andrew, how do you hedge a market like this where you're right, we're one tweet away, or one SEAL Team 6 in North Korea trying to take this guy out and assassinate him away from a holy crap moment?
Yeah, I mean, especially, as an option trader, I always look at a couple of things. One, I look at my option premium levels because, I don't want to be long a lot of premium in the holidays. And, April, after today, we only have 8 trading days left. So April's kind of a crapshoot. So long a lot of premium. And also I look at everything as a risk versus reward setup. Good traders think about how much money they can make. Great traders say, if I'm wrong, how much money can I possibly lose? So every single setup, am I risking 500, 1,000, 5,000, 3,000, or whatever it is, I want to have a risk versus reward setup that is favorable. So I'm always looking at my, if I am wrong, like I said in the beginning of the show, I think it's only about a 55% chance that we go lower. So obviously I'm not pushing too much capital. I maybe have $10,000 of risk total on right now, and I have 120,000 sitting in cash. So, I always look at a risk versus reward setup. Think about, if I'm possibly wrong, how much I could possibly lose on a trade by either having stop losses in place or, have an exit strategy, as you say, because you're not going to be right all the time.
Nope. Jason, Jim, what's your take on what you've heard so far?
Well, I was just thinking a couple of things. One is when the bond market peaks like it did last year, Sometimes it goes on for like 1 or 2 years as the Fed tightens and rates ratchet their way up. And I looked at history, and of course, this is just past, doesn't mean the future, but the stocks do pretty darn good during that period. And then at some point, generally after it has a major advance and the ratcheting up of the Fed continues, it ends very badly. And so basically, that's why I'm constructive on the stock market overall for the foreseeable future, even if we have pullbacks. That's why if we got that drop that the guy was talking about down towards 2,200 or 2,175, that would be really a gift. And so anyway, you know, I'm constructive on it, but I think on the option strategy side, you know, from time to time, you know, hitting this thing with collars and married puts to hedge some short-term stuff. The covered writing is real popular out there on advances. And then if the premiums got low enough and your anticipated volatility was wide enough, you know, you got to give a hard look at the strangles as well.
Perfect.
So that's my view. Yeah.
Okay. All right, let's head on to question 4 here. Now, obviously, as professional traders, we have a little bit more access or a Rolodex or some other assets and resources we can look at. But Andrew, what is in your AWACS, your big radar plane as you trade? What are those resources that you use for financial, economic, or even as we see geopolitical events that can move the markets around that you can throw out to some of the folks listening?
Yeah, so I trade a very unique strategy. I watch institutional order flow in the option market, and then I try to figure out if their option is speculation or hedge. So when institutions are trading options, they can get in a better ROI, return on investment, if they're right in the option strategy versus stock because it's the derivative. So I watch institutional order flow in the option market, and then I try to figure out what is a speculative trade versus a hedge trade. So like position I put on today, we saw institutional order flow of First Solar, upside calls, weekly calls, and monthly calls. So I just went in there and sold some credit put spreads. So, you know, every trade is different. You know, volume versus open interest is always important. You know, every single stock that has options has a different amount of volume it trades in a day. You know, if it trades 7 times usual volume, then it might be a speculative bet. So, you know, my trading is watching institutional order flow in the option market, and then, you know, I allocate my capital on those trades.
Folks, this is an interesting, if you're not an options trader, this is very important to sit up and maybe think about becoming one. Think about the old days. If you don't know what order flow is, here's an example of it. You know, Jason, Jim, and I are all standing in the Apple pit, since Andrew is an Apple market maker. Andrew is wearing his Goldman Sachs jacket and comes in and says, give me, you know, 50,000 Jan 19 Apple 200s. And we're like, holy crap. First of all, Andrew's not an idiot. Second of all, that's a boatload of money. That's what order flow is. The three of us, Jim, Jason, would be like, okay, what's that guy know? And let's kind of draft behind him like a NASCAR. So trading order flow can be extremely profitable, or it can be very dangerous. You have to know, as Andrew said, why they're doing it, and that takes a little bit more of the detective work. So unfortunately, as a retail trader, it's kind of tough to do the detective work. But it sounds like Andrew does a good job of doing the investigating. Jim, how about you? What are on your radar scopes that the retail traders could have access to?
Yeah, I look at obviously many different things. 5 things that come to mind that I would keep an eye on, though, including many others, would be the first thing would be the moving averages on a daily, weekly, monthly basis, and how they are crossed or not crossed. The VIX, to give you an idea on how the option premiums are they fat, skinny, or fair? And of course, that's just a guess, but it's something to look at. Monthly highs and lows on the markets and chart formations. You know, are we have any exhaustion looks, and we have any highs with lower highs surrounding it, or any lows with higher lows surrounding it? And then, of course, Fed actions and major reports coming out. You know, earnings. If you're looking at the commodities, there could be different production reports and other kind of reports. So there's a lot of stuff to look at, but so those are some of the major ones that I would keep an eye on if you're looking at anything.
Sounds good, man. And Jason, what are on your scopes?
Okay, as I said, I trade primarily currencies, but I trade in the cash market. In the cash market, you can't get a lot of the same data that you can from a futures market. So I watch futures, volume, and open interest, and the commitment of traders reports. Commitment of traders reports I find very helpful, but only at certain points. And those certain points are when they are at or near record positions, and they've done that in a short period of time. Like, for example, if the euro makes a big move to the upside and it's on high volume, I'm like, okay, we're going to try to stay long here as long as we can. And then all of a sudden, the volume starts to taper off. But that week, they announce a record long position from the Commitment of Traders report. I would look at that as that market's over, because 99% of the time you get to record high levels of open interest, you're going to get a correction. So the long would be over at that point, most likely. And in my case, I would look to be a short seller at that point. And actually what I do to take advantage of what I call inequalities like that is that I'm actually price agnostic. So I have a long only account that I run my long only strategy in, and then I have a short only account that I run my short only strategy in. So in a case like that, I'd be looking for a signal to short euro, but I'd hold the long with a profit stop under the market. And if it crashed, I'm out of the long with something, and now I'm short from maybe a high print that might be a 2 or 3 month high, and I'll work the short side now. So a lot of times the markets provide opportunity on both sides. We don't know which side is really going to be the big mover. So what I look to do is I try to participate on both sides. I don't really care what the price is so much as I care what the setup is behind it. If the setup says we're at a point where the market's exhausted in one direction, there's a good opportunity for a reversal here, I'll try to put that reversal on and then still hold the other side, because if I'm wrong, then the loss on one side is overtaken by the additional profit on the winning side. But if I'm correct and the market does reverse, I've taken something out of one side, and I'm now holding a good position from the other side that might have a lot of room to go. So I try to play the same strategy from equal yet opposite points of view all the time, and it's very similar to what option traders do. As you know, the option traders are looking to have a hedge position if they can, maybe leaning a little one side or the other, but basically they're looking to capture either a price move or time decay, and I'm kind of looking to do a little of both. You know, when I put a position on, but I watch a lot of volumes, and I watch a lot of futures volumes in the currencies specifically, and I watch a lot of the open interest changes through Commitment of Traders.
Okay, sounds good. I think everything that's listed on the screen there that folks throughout are great resources. The only one I have a big problem with is obviously CNBC. It really is sometimes with a big move in the market, they race to find what happened and kind of backfill it in. It's more or less an infomercial for people, and it's kind of, I call it Comedy Central. I saw a report about 6 months ago. There's a professor, or is it Wharton? He did like Kramer's portfolio for like the past 2 years, and it's a 72% loser. So just be careful of the mainstream financial media. Top Gun Options, I was one of the only financial professionals, and I like being grouped with Jeffrey Gunlock. He trades a little bit more than I do. But one of the only professionals, I predicted both a Trump victory and a 5 to 10% market rally. Goldman Sachs, Citi, JP Morgan were all calling for a Hillary win, walking away. And if Trump won, the market would implode 10%, cats and dogs living together. It was an absolute lie the entire fall by all of these idiots. And the fact that John Harwood is still a, quote, reporter after the emails he sent to John Podesta, Hillary Clinton's campaign chief, is disgusting. So I'll leave it at that. But everybody, I'm not going to take up too much more time because I want to get to some trades. But the resources everybody put up there is pretty good. Zero Hedge used to be kind of an insider thing, but now retail traders know about it. Very, very good resource, but everything else up there is pretty good. All right, guys, I want to get to my most favorite part when I get to host, because I actually do find a couple good trades from you guys. Whether it's today, the week, or out to Jan 19, Andrew, what do you like on your radar right now? A good trade you have on right now, or maybe something you're looking to put on?
Yeah, like I said, I mean, I haven't been that active. Like last week and the week before, I had like the most risk I had on this year. I was long about 600 puts in Urban Outfitters and worked out really well. But I've been just trading small. The activity in the institution hasn't been that big. The one I'll focus on is today's First Solar. We saw institutional buyers of the 28 calls in the weeklies and in April 28 calls. So I just went in there and I sold some credit put spreads. So I'm short the 28, 27 credit put spread in the weeklies, and in April I got 45-cent credit for them. So I have about a 1.7% cushion to the downside. Flat or goes higher, I make money. So when I see activity this week or in April, since there's not that much time left, if I see puts being bought, then I'll probably just sell credit call spreads. And if I see calls being bought, I'll probably sell credit put spreads. So I'm long First Solar via put spreads. So I'd be short put spreads, but more or less always defining my risk versus reward.
All right, sounds good, man. Jim, I know you doing the DVD and stuff like that, but do you have anything on your radar you like to trade right now?
I really think, yeah, I hear you, Whiz. The thing that I would really do is keep some powder dry, and I would wait with some pretty good powder to see if my opinion that coincide with the guy on TV's opinion in that we're in this 2% up or down deal, you know what I mean? And you maybe don't want to go through too much money trying to figure out what up and down means. But if we can break that up or down a little bit here and go on a 5% gapping situation, you know, where you have an order imbalance and you really accelerate to the upside, but then that volume dries up. You know, say we went up to 24.75 to 25.25 on the S&P, or we did accelerate down towards 22.25, 21.75 on the S&P. I'd like to have a lot of powder ready for that, because I think that's where the more significant opportunity would happen in the intermediate term. And the price of some of the commodities, you know, have had some difficulties here. We had a big run up in these metals when we had the missile attack. And there doesn't seem to be a whole lot of follow through, so it'll be interesting to see how that's resolved as well. So there's things going on out there, but that would be my thing. Keep your powder dry. See if this thing happens with regards to when we break this range. Do we accelerate dramatically one way or the other? And is it smart at that point to fade whatever's gone on? And that would be my point.
Okay, Jason.
Well, you know, I really appreciate you asking me what I think, you know, the big opportunity might be that's brewing. And I'm going to go a little off topic here. I hope everyone doesn't mind, but you know, I really think that there is a huge setup happening right now in the natural gas market. There's a lot of ways to play natural gas. You don't have to be on the line for futures every day. You could maybe buy an ETF or another exchange traded product. And I think that natural gas has the potential here to make some absolutely huge gains for people from under this $3 level. Somewhere here, where the top could be when it finally regains its upside momentum, you know, who knows? But it is one of the more undervalued products out there that is still consumed regularly. And sooner or later, the supply-demand relationship is going to put this market at a price level that it's going to be more fair for everyone, either who produces it or who consumes it for a need. I personally think that if there's any sort of government program or tax benefit or something that's passed in at the federal level that allows people to gain a tax advantage for moving vehicles such as trucks, you know, big over-the-road trucks, big use items like that, trains, from diesel to natural gas, liquefied petroleum, liquefied natural gas, or some other form of it. I think the demand pricing, the demand supply relationship will change to the point where there'll be a huge demand for that product that was never there before. And I think that market represents an absolutely magnificent opportunity. I've been looking at trying to find the bottom in this market for 3 years. And I really think that there is an undervalued relationship here. It's one of those things where no one wants to talk about it. Nobody is talking about it. Every time you talk to anybody about it, the whole bottom line is they're all bearish. They're going to delist it, all this kind of stuff. And my experience has shown me, you know, over the past years of trading I've been involved in bottoming markets and topping markets, bottoming markets take a long time, and they get to the point where nobody is interested at all. And somebody somewhere says, you know, we can convert every diesel truck in our fleet for $250 after this federal tax credit, and our cost of fuel drops by 78%. You don't think someone's going to take an advantage of that? That kind of thing is, there's a real good propensity for that to happen. Now, I'm not saying that you'd be trading on the hopes that there be a federal program. I'm not saying that. What I'm saying is we're at a point where this market has an opportunity developing, and it won't take a whole lot of something somewhere, I think, to create a nice edge there. That something will create a big demand for that market that currently isn't being processed, and there's going to be some nice upside. I'm looking at it from futures, of course, but you know, you could get, there's ETFs out there. I won't name them because they don't pay me to say that, but there are ETFs out there that you could use to take advantage of that. Maybe it's the kind of thing that might take 3 to 5 years. So what? You put a few $100 every month out of your paycheck into an ETF that's managing nat gas, and that could be the strongest performer by the time you're ready to retire. It could be that kind of thing. It's sort of like, when people were saying Apple's no good anymore, they're never going to be able to compete in the computer market. There's 4% of the market or less, and boom, they come out with the iPhone. And now you guys that trade Apple stock, you couldn't have made more money, So I really think it's that kind of it feels that way to me. It feels like that kind of a setup. So I would be encouraging our listeners to take some time and look at the nat gas market and see if you find an opportunity there.
Awesome, Jason. I think, who was it, Jim? You said airline earnings or Delta's coming out this week. I wonder Delta's going to get some benefits from the United Airlines dragging and kicking and screaming passenger off a jet. That was pretty enjoyable to watch that. For the Whiz fighter, I think I gave my kind of trade idea out at the beginning of the session here. I'm looking at that Iron Condor. As we've been talking, guys, it's been interesting to see this 20. You rarely for an hour see the S&P 500 just kind of this band right here, a little bit of a pop, and now we're getting back. So I like the Iron Condor that I put out. And then I got a couple hedges on, but here's the Iron Condor if you want to see the strikes. I'm going to be debriefing this tonight and the rest of the week. I'll tell you in a couple minutes where. But the 2375, 2340 are the short calls and puts there with some hedges, $5 away on SPX. I trade SPX. I don't trade SPY. Maybe some different tax treatment. Hint, hint. So I like that trade. And then I like you got to have some sort of holy crap hedge on here. I love being the house. I love being MGM Grand. Casinos don't look the way they do because they give away money, or car dealers. Okay. So I love being a seller. So buying this bear put spread on SPX makes me want to get sick. But to be honest with you, as we all laughed earlier, breaking news, the market's either going up or going down. That it isn't funny because I think we're in for a binary move. And in between the 50 and 200-day moving average, this is like trench warfare in World War I. Nobody runs around here no man's land. So if we're gonna break this 50-day moving average, it will be for a reason, and most likely a pretty bad one. And then it's look out below. If we don't break it, I think we do the Price is Right yodeler and keep heading up. We ain't gonna see some wrath of God rip your face off rally, but we'll. I think second or earnings are going to start pushing us up there. So take a look at some sort of hedge, on SPX out, and don't look at if it's a trade, you want to make money. This is my lingo. If it's a hedge, you don't mind if it lost money. Why? Because that means all your other stuff is green. If you got a blinding red in your portfolio when the market's up triple digits, you're doing great. It should be a little Christmas tree-ish or Kwanzaa or whatever the hell, winter solstice. If you're all green or all red on one of those days, you're not necessarily hedged. And I can teach you how to do that this week here at TGO. With that, guys, I'll tell you what. Let's do a wrap up here. Andrew, let everybody know how they can get a hold of you or do what you do. I know all the trading rooms you run at Alpha Shark. How do we check that stuff out?
Website's alphashark.com. People can always personally email me. I try to return everybody's email within 24 hours. It's andrew@alphashark.com. Like I said, we run one of the biggest paid trading rooms in the world. Opens at 8 a.m. Central, goes till 3:30. We have 5 moderators of the room, all trading their own capital, mostly equity option based, some futures, some stock as well. Also, we have proprietary based indicators and about 14 educational courses on demand and DVD. But they can always email me, andrew@alphashark.com.
Awesome, Andrew. Great working with you again, my friend. And Jim, how can we check out the options processor stuff?
Okay, 2 ways. You could go to optionprofessor.com, and there's 7 DVDs there that you can check out. And it goes over beginning, intermediate, and advanced strategies. And also, I would like to invite everybody to an event that I'll be speaking at on Thursday. By going to tradingadvisораlerts.com, they can register for that and basically also receive an article called The Mastering the Art of Probability. So I think that would add value to you guys out there. So I did want to make that invite as well.
Awesome, Jim. We'll check that out. And Jason?
Yeah, real quick. If anyone has found an interest in some of the things that we talked about from my end and would like to talk a little more, feel free to consider me a friend in the business. At support@theliononline.com. Not currently offering any available online tools for trading education and training right now. Basically looking at forming new relationships with people that are interested in maybe more of a coaching relationship. But at the same time, that could change. And I do have many products that are available on demand if you're willing to ask for them. So you're welcome to start a conversation with me, and we'll talk a little bit, and I'll be more than happy to offer you what I can if you're interested. Also, been published by Wiley & Sons 3 times. If you have an interest in reading some books on trading, I have 3 titles published by Wiley & Sons. First one, Trading Rules That Work. You're interested in that, that's available at Amazon. Second book, The Art of the Trade, What I Learned and Lost Trading in the Chicago Futures Markets. And also my latest book, Time Compression Trading, which is a little bit more of a deeper look at my theory of how psychology shows up in price action and how to create better edges. So if you're interested in those things, feel free to go to Amazon.com. And I'd love that $2 royalty check as opposed to downloading it for free from the illegal servers over there in China.
Okay.
But yeah, really, it'd be nice to get a royalty check once in a while. But in any case, appreciate you having me on. Thanks again. And as always, I love the opportunity to talk. So thanks again.
You bet. And folks, real quick for me, we kick off what is called Full Throttle here at Top Gun Options this week. It's a full week of live trading. Sans Friday, obviously, for Good Friday. You can head to go.topgunoptions.com/joinft. That means join Full Throttle. It's free. It's an entire week, kicking off at 8 tonight with our in-doc brief. Tomorrow morning, I'll do a joint weekly options and primary brief. Weekly options, obviously, trading weekly options. And then we also have front month and Jan 19 positions on. Accelerated retirement is on Wednesday. We'll do some vertical spread training Wednesday night at 8. The advanced live trade brief with Doug Robertson. He's our vol arb trader. He's going to put some earnings trades on, and then we'll still do an event on Friday where we'll debrief the week, and I'll take a look at some of the weekly options trades I put on this week, kind of like that Iron Condor. So again, and then we'll throw an OPCL, the options pocket checklist. We charge $45 if you want to go buy it, and our trade plan is $55. Make sure you strongly review the trade plan before you show up tonight for our in-doc, and grab a glass of wine because it's going to be fun tonight. Go.topgunoptions.com/joinft for Join Full Throttle, and I look forward to seeing a lot of you folks tonight. Okay, so with that, David, we'll end 8 minutes early. I have a doctor's appointment in West Boca, which is God's waiting room, at 2:15. So we're gonna cut out a couple minutes early, man. So I appreciate you letting me host again, and I'll throw it back to you.
All right. Well, good luck getting to your doctor's appointment.
I need it. There's a lot of blue hairs that all you see is 2 hands on the steering wheel, and that's about it.
Well, yeah, great show. Just a reminder for everyone watching, be sure to hit the YouTube subscribe button to make sure to get updates on future shows. You can also go to TimingResearch.com and watch any of the past shows or download any of the past reports there. I've also been providing the audio-only version of MP3 files for the shows for the last few weeks, so you can download that if you want. And I just want to remind you to join us next week on April 17th. Steve Lentz, Larry Gaines, AJ Brown, Sam Borgi, and Dean Jenkins will be here. And just want to thank my guests again for this week. Andrew Keene of AlphaShark.com, Tim Kenney of OptionProfessor.com, Jason Jankovsky of TheLionOnline.com, and Matt Buckley of TopGunOptions.com. Thanks, guys.
Thanks again, Dave.
Thanks, David.